Today I'm going to discuss about very important tool used in financial sector, especially that affect to macro economy. The governments are using to control the entire economy using different tools. Today I'm going to talk about OPR, overnight policy rate. Some countries are using dual policy rates, some are using single policy rate. What is this dual policy rate? Dual policy rate means central banks are using two major policy rate, deposit facility rate and lending facility rate. All these are interest rates. All these are interest rates. These interest rates are using to control mainly the money supply. Some countries are using two rates, as I told, deposit facility rate, standing deposit facility rate and standing lending facility rate. The interest rates is fluctuating within the corridor in between these two facility rates. Right? What is this lending facility rate? Lending facility rate is the interest rates that central banks has determined when commercial banks are borrowing money. Commercial banks are borrowing money to solve their liquidity problems. Right? If they have a deficit of money, then they are borrowing money from central bank. Central bank has a policy interest rate for this. Right? That is lending facility rate. Deposit facility rate is if commercial banks, if they have a surplus, commercial banks can deposit that surplus in commercial bank. Sorry, in central bank. If they deposit this, their surplus money in central bank has another interest rate for that, that is deposit facility rate. What is happening if these rates increase or decrease? If central banks increase this deposit facility rates, as an example thing, central bank is increasing this deposit facility rate, commercial banks are encouraged to deposit their surplus money in central bank. As a result of that, central banks can't issue money to general public. That means they can't issue money for circulation. Why? Their surplus money they have deposited in the central bank. This is reducing the liquidity of central bank, commercial banks. What is happening if lending facility rate increases? If lending facility increases, commercial banks, they're supposed to pay higher interest to the central bank money they are borrowing. Right? That is lending facility rate. If this is increased, commercial banks are discouraged. They are demotivated to obtain money, borrowing money from central bank. Then what is happening? They are not borrowing money and lending to general public. That is also decrease in the money circulation. Then these two facility rates, central bank can use to increase or decrease. If what is happening, this rates decrease. If deposit facility rate decrease, commercial banks, they decide deposit money in central bank is not worth. Why? The central bank is paying very low interest rate. Then what they are doing is they are lending those to general public. That means they are going to the circulation of money in the country. What is happening if lending facility rate decreased? Right? If lending facility rate decreased, central bank, the commercial banks encouraged to borrow money. Why? Central banks is charging very low interest rate. The borrowing cost is very low. Then they encouraged, right? Then they encouraged to borrow money. Then they are borrowing money from central bank and they are lending to general public. That is also increasing the money supply. That why those money goes to the money circulation, right? That is going to the money circulation, right? Now these two facility rates are working in that way. Then the OPR, overnight policy rate, this is the interest rate at which a central bank lends to commercial banks for overnight borrowing, is one of the key tool used in the central banks influence short-term interest rates. There are no two rates. There is only one rate in the central bank is using one rate, that is overnight policy rate. Purpose of this OPS, or OPR. The OPR tool, OPR is a tool for central banks to control inflation and stimulate or cool down the economy by raising the OPR, overnight policy rate. The central bank makes borrowing more expensive, thereby reducing spending and investment. Lowering the OPR encourage borrowing, stimulate spending and economic activity. Here, one policy rate to be used for both lending and deposit, right? Lending and deposit. In dual rate, what was happened? There are two policy rates to treat lending and deposit separately, right? The OPR directly influences the cost of loans and credit. A higher OPR can make loans more expensive for individuals and businesses, potentially reducing economic activity. As an example, now, Sri Lanka moved to this policy rate OPR from as far as I can remember, November 2024. November 2024 in Sri Lanka. For example, the central bank's OPR is key rate to determining the general interest rate environment in the country. If influence other interest rates, including those on deposits, loans and government securities. The OPR is often adjusted during the central bank's monetary policy meeting. Changes to this rate can be part of a broader effort to either combat inflation or stimulate economic growth. The OPR likely component in central bank's toolkit for managing the economy, and it plays a central role in the shaping financial conditions. The dual rate system and the single rate system. Single rate system is the overnight policy rate. Dual rate system is deposit facility rate and lending facility rate. These are both monetary policy tools used by central banks to control liquidity and interest rates in the banking system. However, they operate differently, impact the economy and financial markets in distinct ways, right? Now, dual system policy. There are two standing deposit facility rate. This is the rate at which commercial banks can deposit their excess reserves overnight with the central bank. standing lending facility rate, this is the rate at with which commercial banks can borrow from the central banks overnight. These two rates form the corridor within which short-term interest rates in money market typically influenced. The central bank could use these rates to manage liquidity in the system. Right? Now, in dual rate system, separate deposit and lending rates are there. By using two rates, the central bank distinguishes between borrowing and lending functions. The SDRF deposit facility rate was the banks to park excess liquidity, while SLRF allowed banks to borrow from the central bank in time of liquidity shortage. The interest rate corridor, the difference between the SDRF and SLRF created interest rate corridor. This means that market interest rates would typically move within this corridor, guiding the general level of interest rates in the banking system. Now, this dual system, if we discuss about the complexities of dual interest rate system, the system could be more complex for both policymakers and market participants, requiring careful adjustments to both rates. And the market confusion, the presence of two rates sometimes led to confusion about the central banks intended to share on monetary policy. Then the single policy rate system, the OPR system, that is simple. The advantage is simplicity, right? To use one rate market, easier for the markets to interpret the central bank's policy stance. There is no need to balance two rates or make adjustment to each independently. And the flexibility with the OPR, overnight policy rate, the central bank can more easily control the overall level of interest rates in the economy, as it is the sole policy instrument. But in disadvantage factor, potential for over reliance on one rate. Since the OPR is now the primary tool of controlling monetary policy, any changes to it must be carefully considered, as it will have a broad impact on various sectors in the economy. There are no two policy rates to manage in two different ways, right? Then that is very important, right? The dual system served its purpose in guiding monetary policy by providing range for short-term interest rates, but it could be complex and harder for markets to interpret clearly. The single OPR system simplifies the central bank's monetary policy framework, providing clear signals of the market and allowing more direct control over the interest rates. By moving to single rate, the Central Bank of Sri Lanka has aimed to streamline its policy tools, making it easier to manage inflation and economic growth.